Hi, I'd like to welcome everyone to Liquidity in Bear Markets. It's been a crazy couple of past hours in crypto, and I'm your host, Greg Lim with The Block, Company Intelligence Research Director. I'll ask my guests here to do a quick intro, and then we'll jump right into it. If we could start with Aurora.
Hi, I'm Aurora Schwartz, Director of Strategic Partnerships at Wintermute. I'm from traditional finance background originally, was an interest rate swap broker for many years. Prior to Wintermute, I was a trader at Citibank, trading cross as an advisory for ultra high net worth and family office, and served on the private bank growth board. Wintermute is one of the world's, leading global liquidity providers. We partner with token issuers, traditional funds and institutions, family office, hedge funds, and high net worth individuals. And our range of services covers from market making, treasury management, OTC and derivatives trading, risk management. And we provide support for projects and invest in the ecosystem. And we've got an extensive OTC coverage, which provides best execution and supported via an API, our user interface node. And we've also got a manual trading chat. It's great to be here today and really an interesting topic given the state of play today.
Perfect. So we'll start off with, what is the state of the markets now? What do you see as reasons for lower trading volumes? And do you see signs of recession, a bear market, or a crypto winter?
Yeah, look, it's there's a lot of macro issues at play at the moment, and it doesn't look very good. Not just kind of on the digital asset space, but if you look at the global economies, I guess liquidity has been withdrawn at a record rate. You've had central banks printing money for so long, and now that's retracting, and you're really seeing a pullback in the markets as a result. If you look at sort of the digital asset space, I guess retail volumes are down, but we're still seeing actually significant demand from institutional players. There is still strong appetite to execute in this type of environment. But with that being said, there's also different products for this type of environment. Derivatives in particular, we're still seeing strong and robust volumes, particularly on the option side. Retail, I guess, it's less present because of several reasons. Earlier in the year, you obviously had these significant market impacts with people losing money on Terra, Celsius, Voyager, and there's been, other incidents in the market which have kind of spooked the crypto markets. And, retail has been heavily hit. You've also got these other externality factors where you've got inflation, energy, interest rates going up. And so, consumers, retail segment have certainly tightened their purses, and they're not in the same capacity as they were last year during the bull run. But with that being said, when you've got sort of retail that has more softer flow in general, subsequently there's less token launches as well. So you're seeing less projects launching to market on the exchanges. They're kind of waiting, seeing how maybe to do it in Q1, Q2 next year. So overall, you see sort of prices down and people reluctant to enter the space. I guess with that being said, though, with their OTC offering, we do see a lot of that institutional flow still, and we're seeing more TradFi entering the space. Not sort of too fast, but slowly they're trickling in. And that's going to have quite significant impacts for the market at some point. So on one hand, you've got the retail segment down, but then you've actually got more and more institutions participating. And so that's showing more positive trends in volume as a whole. And I think, for us, we have quite a diversified, OTC offering that we can have, quite a wide range of tokens. If you look at the more traditional players, they're heavily focused kind of on BTC and ETH. But because we have kind of the larger ecosystem in DeFi and CeFi, we can offer that larger range of tokens, which is particularly interesting because some institutions will have, maybe large positions in certain holdings, and they need to try and sort of work those positions in a timely manner. So hence you're able to offer better pricing with a liquidity provider that has more breadth of coverage on the market. I guess if you look at kind of last week as well, we had a sort of a slight rally in the markets in October, and that came off last week. Obviously, we're down again today. But, if you look at kind of where we are in terms of, is recession around the corner, you had sort of a jobs market report released last week, and that painted a strong labour market. but it did little to kind of shift the expectations of where interest rates might go with the Fed. And so while you've got one hand, the US not in a recession at the moment, I think most economists are really sort of factoring in that there will be a recession around the corner, particularly if the Fed continues to hike, and that could sort of tip the economy over.
I can jump in a little bit just quickly. Hey guys, thanks Greg for having us. Mike Higgins here from Hidden Road Partners, which is a multi-asset prime and clearing business. So just on the state, the market's certainly been in a lull. It's caused by a variety of compounding factors. First at the macro level, we see a rapidly raising interest rate environment, and so that clearly causes asset prices to have lower valuations. The result is a decrease in the wealth effect, effectively hindering retail's ability to participate as aggressively in capital markets. Crypto's, no exception there. Secondly, we just went through the largest credit blowup in crypto history, sending shocks through the system. So, many of the leading companies were particularly affected, and if they called back billions of dollars of loans, which effectively drained, credit from the system. Obviously, what this means is clients have less, access to leverage, and their trading volumes and profitability are going to drop as well. A little bit at Hidden Road, we're extending financing to high quality quantitative trading firms, a lot coming from the TradFi space, which Aurora touched on. So we're certainly seeing an uptick of onboarding of those types of institutions. We also see an uptick in the amount of financing that we're extending to these tier one names, again, who've likely had calls reloaned. We provide kind of sticky, more stable capital. And so I think with some of the institutional solutions that folks like Hidden Road are bringing to the market, we're going to see an influx of these new entrants, predominantly coming from the TradFi space, both on the market maker side as well as the consumers of liquidity.
Gotcha. Bill, do you have anything to add there?
Sure. I'll give you an intro. Bill Barheit, thanks for having me. I'm CEO and founder at Abra. We're a 7-year-old crypto banking platform. We service everything from institutional counterparties, mostly TradFi. We're one of the larger lenders in the crypto space, especially after the events of the past few months. We service everything from institutions to private banking clients, combination of family offices, trusts, retail, down to our global retail platform. And I'll echo that for us. I'll give you kind of the range of what we're seeing from institutional to kind of maybe private banking to retail. Institutional side, it's been a great year for us. As I mentioned, post kind of contagion from 3 Arrows Luna, our institutional business has really taken off in all aspects of the business. On the lending side, we're one of the few kind of pure play lenders now in the crypto space that's got the trust of the kind of traditional finance world at large scale. And that's been great. Our new OTC business is actually scaling very, very quickly, both spot and now options as well as programmatic, which we're in the process of launching with a few counterparties. And that'll continue, I think, to grow just given the pipeline we see and the trust we have. It's also interesting because we're also one of the few that basically can deal with both the lending as well as the trading aspects of the business for institutions now, which is something we've been doing for retail for a while, but we've now scaled it to be able to manage, very, very large counterparties. On the kind of private banking side, it's kind of a tale of two cities for us. We're definitely seeing on the ultra high net worth side a lot of money coming back into the market now. It was kind of a big shift for us from kind of, I would say, August, early September to now. The tides have definitely turned and we're seeing money come back in. Retail is still kind of volatile depending upon which way the winds are blowing on any given day. I mean, clearly volumes are massively down. On dollar basis, they have to be just because the mark to market. But in terms of actually pure number of trades on a coin by coin basis, even there, the volumes are down a fair amount. Not as much as they are on a mark to market basis, of course. But yeah, look, I mean, from a macro perspective, everybody's got their opinion. So, but our take is that look, I've been in this space for 30 years. In space, whatever you want to kind of both the tech side and the investment side, and I've seen these markets before, and I can tell you that usually when people are as fearful as they are now, it's usually a really, really good time to be placing smart bets. And we're seeing a lot of smart counterparties doing that. Our treasury business is booming on the pure play crypto side, but even on the dollar side, where people are looking for smart yields because they think that the current treasuries are unsustainable, which they are. The economy can't support these yields. So that all bodes well for the future of our space, and we're responding accordingly.
Gotcha. So moving on, what does it take to maintain liquidity in these markets? How should institutions be thinking about efficient execution in times like these?
Well, for some folks, it appears to be a direct line to CZ. I'm guessing the answer might be a little different for all of us. But maybe I'll go first. I'm just going to reverse the order. I don't know. I mean, look, risk management is key. I've been out talking about risk management. I'd go on podcasts like 2.5, 3 years ago. People were like, Bill, could you talk about something else? It's a little stale. It's a little boring. I'm like, sure, whatever you want. And now the invites are, Bill, can you come on and talk about risk management? Because we really want to understand why Abra seems to be the only company that's completely unaffected by all this bullshit going on. And so, it's an infinite game. It's not a finite game. This expression, infinite versus finite games. And we intend to be a crypto bank 25, 30, 40 years from now. And there's no other way to do it except these tried and true risk management processes. And let me tell you, the tide's going to go out again and again and again and again and again. And history will show, that those who actually do what they say from a risk management perspective will have and be able to maintain the appropriate liquidity levels to service their customers. And that's true. That's not a crypto specific thing. It's just common sense, really.
I'm going to reverse order. I'll jump in a bit. I'll echo some of what Bill mentioned. But as for what it takes to maintain liquidity in the market, it's key to remember liquidity is normally driven by market makers' access to the markets, to financing, and to Bill's point, risk management solutions. I think we understand that without the right frameworks for institutions to participate in an asset class, the market's going to function less efficiently, affecting both, kind of retail and institutions. But to the second part of your question about efficient execution, I think it's important for institutions to focus on execution ownership, full transparency into where their orders are who they're interacting with, where their orders are going, as well as starting to run best execution as they would in any other asset class. And so we think there's going to be more and more solutions in the norm that arise about measuring the best X. So I'll pause there and pass that off.
Yeah, no, I think to your point, Mike, I think that's spot on. Actually, I think in times like this in particular, it's really important to understand sort of how many liquidity pools are underlying the execution in order to get that best X, regardless of sort of how you connect. It's important that the orders are executed across a wide range of exchanges, pool aggregators, and CeFi and DeFi. I think it's also important that you realize what you pay for. For example, with lower liquidity, it's important to not only look at the spreads, but the top of the book, and also the spreads of the sizes you'd like to trade in. So, I mean, there's one thing getting a price in 2 BTC, but what if you need to trade 10, 20 plus, large clips? You need to have a liquidity provider that can really support that, particularly when you've got lower volumes. A large ticket size is going to be very impactful for the market. And so you really need to have someone that can support that. And so having that sort of capability to execute across such a large breadth of venues makes all the difference. I know from our side, we're connected to, such a huge range of exchanges and have that technical sophistication already set up, provide sort of smart and efficient execution via our OTC offering and user interface node. And we basically, for an OTC manual trade, for instance, if you've got a very large order that might be, that might move the market, you're going to do that via manual chat. Even in traditional markets, you'll still do, large clips OTC. And, a lot of people tend to work sort of maybe a TWAP, which is like a time-weighted average price order. But for us, we sort of, we want to reduce the slippage and we use sort of our theoretical mid price. So for us, like there's no hidden fees as you'd have kind of on an exchange where exchange charge fees. When you're plugged into an OTC desk directly, a liquidity provider, we don't charge fees. And so you're really getting the best spread and best execution in a very fast, efficient manner when you go direct.
Gotcha. So following up on that, with volumes going down, retail getting less involved, we're seeing traditional finance institution participation coming up a little bit. What type of institutional players are doing this? Do you see more demand from these types of players? And what coins and assets are attracting them into the market beyond the classical Bitcoin, Ethereum?
I'll go first, given I haven't had a chance to do that. So I'm going to do this through the lens of a prime broker. And so we certainly see the TradFi market makers getting heavily into the space. We're working closely with them to make the access into the market more efficient. Leveraging a prime brokerage is, in our view, is crucial, as again, these solutions are something that they know very well, they understand, and ultimately they trust to help them scale across what is a highly fragmented market. Because of some of these new entrants and the liquidity bring, as well as these strong crypto native market makers, we're starting to see the emergence of other participants like the hedge fund fraternity, even some real money asset managers coming in. They're coming in on the taking side of the market as they're ultimately looking to add another asset class to their repertoire. So ultimately, I think as the market continues to broaden, we're likely to see more and more alpha-driven strategies being deployed, which will create a bunch of other opportunities. So as for coins, again, Wintermute probably better here, but our clients are less fundamentally driven and more high volume trading firms, but I certainly get the opportunity to catch up with them on trends, and it's clear Web3 is there, and so it's clear that many of them that have a chance for the net citizens to kind of own their own digital footprint's a big deal. So I think a lot of these guys personally are investing in Web3, whether it be equity or tokens, and so I think that trend will only continue as more and more talent enters the industries and creates businesses that'll help shape, frankly, the future of the internet. And my last piece here, guys, sorry, is, and so summing it all up, right, is there, do we see these institutions coming in, help turn around the market? I think the answer is clearly yes. We see, new players with real alpha and investment strategies. And so with, better and more solutions available in the market makers, should also see an increased opportunity to capture spreads. I'll pause there.
Yeah, no, I agree with that, Mike. I think we're certainly seeing, as you'd mentioned, a lot more of the traditional funds and institutions coming to the market. I think at the moment, predominantly, I think the token coverage is still focused on the big cap coins, particularly kind of from the TradFi side. They look at obviously BTC and ETH, and then some are kind of dabbling now into some other coins. But we do see some interest from some institutions that might have, large holdings in certain coins. But one of the things I think from a good liquidity provider as well is we're always trying to educate, market participants and institutions that, there's more to, this ecosystem. There's more layer ones than, just a BTC and Ethereum. So I think that there's a lot of opportunities to really educate kind of the traditional funds and institutions on, potentially gaining a lot more access to the ecosystem.
Yeah, I guess just I'd say two things. One, we see basically a broad spectrum of risk tolerance and interest. And so we have on the one side, we have kind of our next gen token fund, which is getting a tremendous amount of institutional interest right now, meaning, on the next run up, what's the next Solana or Aptos, whatever. And it's relatively illiquid, okay, because it's what's next. And the lockups could be for a while and the returns could be out for a while. And then from TradFi, we're basically seeing, more conservative, okay, walk me through yield processes for, Bitcoin, ETH, USDC, and, what are the ARB opportunities with USDC and Tether still, and are they going to close? And, walk me through synthetic ETH versus ETH, and, is it really going to stay, pegged like it is now, or are we going to get back to the summer? And everybody's looking at, on that side of the spectrum, very, kind of traditional ARB opportunities, but applied to crypto. And then we're also seeing kind of the next gen of quants who basically are digging into smart contract code and are asking us for help on basically looking at alpha opportunities across exchanges, across contracts, and real-time lending integrated. And so we're seeing a huge spectrum now of demand for our expertise in totally, obviously it's all crypto, but different aspects of this ecosystem.
Gotcha. So, on the topic of traditional finance, how do you see derivative markets growing in the near and long term? The spot to derivatives market relationship in traditional finance compared to that in crypto remains quite dislocated.
Yeah, look, I think derivatives in a lot of jurisdictions in digital assets, it's still very difficult for certain market participants to touch the space. You see a lot more sort of Western exchanges in particular looking to expand into derivatives market, like their Asian counterparts. And I think that will contribute to sort of near-term growth in the market. In particular, I guess, there's a lot of hedging solutions and derivatives are particularly helpful in sort of bear markets. So there's certainly medium and long-term opportunities. I think the relationship between sort of spot to derivatives markets, it's very hard to compare with the traditional markets, I think, in this space, because derivatives is really still in its infancy stage. And from last year, no one was really doing, a lot of firms were not doing proper risk management, right? This time now, it's a completely change of environment, and all the firms are now realizing, look, we've got to have robust risk management systems into place. We've got to have, good hedging solutions, good strategies. And I think so this is how you're going to see the derivatives market evolve in time in this space. But I don't necessarily think it's really comparable with the traditional finance market, also because you have perps, which is quite an innovative product in digital assets. And so you don't see that in TradFi. And so having the perp market as well, I think adds, people can, have access to leverage, which, in times of this type of environment, it's difficult even in TradFi to get the leverage that they were getting, last year. So I don't think you can really compare the two in this particular instance. But it's certainly, I think the real growth in the market is certainly in the derivative space, and it's very exciting. I think some of the products that are going to be coming out, I think you'll start seeing a lot more maybe structured products and other more sort of more exotic strategies down the line. I think the main focus really, we still see mainly more plain vanilla products. But, as more family offices and sophisticated funds are getting more active, that they will require these type of more sophisticated structures.
Yeah, the convergence between the structured products and derivatives that you see in traditional finance and crypto is going to accelerate. And we're already seeing it, and it's getting faster. I agree with Aurora that there are a few nuances, like obviously perps and the 24/7 nature of crypto, and it changes how risk management might work in a prime model. But by and large, they're converging, and that's just a function of demand. There's nothing's outside of 24/7 and the regulatory aspects of crypto. By and large, when it comes to structured products, there's nothing special about CeFi aspects of crypto. DeFi is a different story because you can do a whole bunch of things that you can't do in CeFi, overlaid with the fact that it's 24/7. That's going to be an interesting evolution to me, to see how traditional players start to take advantage of derivative opportunities in the DeFi space, which is barely started. I mean, it's really nothing right now, but I think that's going to explode in the next year. And it's very complicated, right? I mean, the programmatic requirements, the software development requirements, risk management requirements, monitoring tools requirements, multiple sources of liquidities in parallel across exchange requirements. The list just goes on and on and on. But smart people are figuring this out right now, and it's super interesting, and the opportunities there are enormous.
Definitely. So, with the declining liquidity, what do you view as some of these short and long-term opportunities for institutional traders?
I could take that one a little bit. So again, the market's in a lull, which is, never a fun thing, but oftentimes when there's diminishing liquidity, it's a function of lower trading volumes. And so this makes challenging opportunities for alpha gen, and they become fewer and fewer. I think back to like my high frequency days, and these are great moments of like downtime when institutional traders can focus on optimizing their infrastructure, workflows, solving for capital inefficiencies. And so, again, from the lens of a PB, we see some of these names now looking at that and integrating to a PB. They're working on optimizing their order routing, et cetera. And so basically doing all of the work during these times that when the markets are hot and busy, they really don't have much time and focus to do. And so I think those are kind of some of the short-term opportunities that will pay dividends in the longer term.
Yeah, I think that's spot on, Mike. I think you're seeing that both on the projects, really good, solid blockchain projects are really building mode now. They've obviously, raised enough cash during, the last sort of 12 months, and now they're really in building mode. And even like, firms as ourselves, we're, been upgrading our sort of API and our user interface node. And really building new products, because it's actually a perfect time to take advantage of these type of markets where, during these bull runs where everyone's just flat out, there's no time to be, doing additional building and creating new cool products. So it's actually a very interesting time where I think you'll see some really innovative products come out at the end of it. And I think long term as well, there's certainly, I think on the trading side, there's certainly, potential buying opportunities, when you get further pullbacks in the market, and sort of building sort of some, interesting structures around those, to sort of, particularly for players that maybe haven't sort of entered the market or were reluctant when, you had this rally and didn't know when to enter. There certainly be buying opportunities, in the coming year, when the market sees fit. So I think, it's just a great time to build and upgrade a lot of products. And also I think there's just a lot of other platforms out there where I think you'll see consolidation as well, actually in the space. From, all of these market events, I think you're going to see consolidation in exchanges, in trading firms. And I think there'll be, a bit of a flush out, I think, which is good, right? It happens in TradFi all the time, and I think it's at the end of it, all the firms that are really building strong products and that will sustain at the end of this cycle will be even stronger going forward.
So I guess I'll also add a couple of things and integrate the retail perspective, because we obviously play in both. I would say on the institutional side, the real opportunity right now is definitely, I'll echo the comments on structured products, derivatives, programmatic access to liquidity pools. And, we're investing really heavily in those areas. And, that part of the business is growing. And it also tends to be, price agnostic, but obviously volatility friendly, right? So I think that, in the next 6 months, volatility is going to increase dramatically. In the crypto markets. I would also say that as it relates to price, that's going to be significantly more retail dependent, right? Because basically crypto comes down to network effects and money supply. And so every single institution on this call can come in with $1 billion right now, and it might move the price once, just because of overall money supply. But without retail, you don't get the network effects. And I would posit that Bitcoin was probably on a march to 85, 90,000 when China stopped the network effects. And so that's why the rundown hasn't been as big this market downturn as probably the others, is because we didn't get as high as we probably would have because China stopped the network effects. So I do agree that, this is a great time to be building on both sides, both retail and institutional, and we are. And we're clearly seeing the adoption on the institutional side. But the network effects, by and large, in our space, are driven by network effects of users, not speculators.
Gotcha. So, with that in mind, what do you see as potential catalysts to, jumpstart that next run and start increasing liquidity?
I think the catalyst to help jumpstart kind of the market and add liquidity back are actually the very solutions and infrastructures that are required for institutions to properly adopt digital as an asset class. Institutions, creatures of habit, and they require certain infrastructure such as custody solutions, again, routing technology, and equally as important is a prime broker. The word's used a lot, but a real PB. It's important that the prime broker is truly technology agnostic, liquidity agnostic, and custodian agnostic. And that the PB provides proper cross margining and margin financing capabilities is one of the main factors that are going to allow the institutions to enter the market. Moreover, I think improved efficiency specifically for the market makers will actually make it again easier for these larger institutions to come in and run different taking strategies. So it creates that, again, to Bill's point, a bit of that network effect. If you improve liquidity on the market maker side or their efficiencies, they tend to bring in other participants. And so kind of wrapping up this point for me, ultimately institutional infrastructure is what is required to bring in the bigger and more diverse counterparties. And as this market broadens, the liquidity landscape will broaden as well.
I would touch on that point as well. I think there's also not only sort of building more robust sort of systems and even custodian solutions in the space for traditional institutions. I think for us as a trading firm, because we do have that breadth of coverage and access to liquidity, that we can already actually do very large institutional size clips. But I think there's more broader macro issues at play in terms of, I guess, what's a potential catalyst to really jumpstart and increase liquidity in the overall digital asset space. So I think, it really depends. A lot of this is still macro, depends on the US economy. While rates are still going up, it's a really tough time. And I think, once you start getting a rebound in the economy, and it will happen, I think you'll start seeing more players in the space. You've got Fidelity, Bank of New York Mellon doing custody. So like getting these TradFi participants on board now is great, because it's really kind of adding validation to the space. And what will happen is you'll get a magnifying effect with more and more people participating in the digital asset markets. And as the banks sort of slow, a lot of the banks have capital markets requirements, so which is they've got their own different constraints. But a lot of the traditional funds that are now slowly starting to have Bitcoin or ETH access as part of an overall portfolio, it really has that amplifying effect, and more people then want to have an exposure as part of their overall portfolio strategy, and that's certainly not going to go away. It's really going to grow exponentially.
Yeah, I don't think crypto has a liquidity problem. I think crypto has a macro problem, which was exacerbated by risk management of folks that were taking advantage of the lack of credit problem that we had before, with inappropriate risk management layered on top. And when the tide went out, we saw who that was. And I thought we were done last week. I guess we're not. But look, I think the credit tightening is about to stop. On the margins, rates will still be high, but on the margins, the credit tightening by and large will ease dramatically. And generally, you see in these markets a rapid race to put cash to work once retail is in dire straits. That tends to come first, and then retail tends to follow. So we'll see, but I don't see it so much as a liquidity problem as I do a macro credit problem. But I think the good news is the powers that be have no choice but to change the situation on the credit side, because if they don't, things are going to break in a way that's just not sustainable for the planet. So that's the good news, I guess.
Gotcha. Well, that's all the questions we have. We'll open it up to some Q&A in the chat. I'm just going to start from the bottom and work my way up. But why has market making activity gone down on DEXs?
Look, I think there's been a number of reasons. The light's gone back on in the building. I think there's a number of reasons why liquidity is down on the DEXs. It's never been comparable. Even when there was for instance a busy day in Centralized, we were doing over $10 billion a day, and then a busy day in DeFi is $1 billion. So the market's not comparable in terms of like where a lot of the activity lies. It's still really focused more on the CeFi side of things, where the big volume is still. DeFi still has a lot of hurdles to get mass adoption, and I think when there's been a lot issues in the DeFi ecosystem, it makes people reluctant to potentially sort of enter into that space. But I think more and more participants are looking to get involved.
Gotcha. And then in terms of centralized entities, whether there's more or less of them, do you think that helps or hurts liquidity?
Does what help or hurt liquidity? Market making?
No, for the larger number of centralized.
Greg, is that what you're saying? More marketplaces?
Mm-hmm. Yep.
Well, we need competition, and that's going to work itself out. I mean, in crypto outside the U.S. Allows for regulation to proceed at a pretty reasonable clip. The question is, how are these actors acting behind the scenes when they say they're doing X, in front of the camera? Are they really doing X behind the camera? That's the bigger issue. But we need the competition, and I think that, there's an emerging competition between CeFi and DeFi. That's great. To the earlier question, I would posit that there's a lot of wash trading happening in unregulated markets still. That basically makes volumes look unrealistic in many cases, and it's still happening. Not to the degree that it was 5-6 years ago, but it's still happening. And this is only going to work itself out over time with more and more competition, more and more use cases. Eventually, exchanges become liquidity rails for the broader banking system, in my opinion. As our bank and other traditional banks and other neobanks basically start to adopt DeFi and other aspects of crypto, they're going to need the liquidity of exchanges, market makers, folks on this call, et cetera, to help manage this all in the background, just like we have repo markets today in traditional markets, right? So it's going to evolve very fast in the next 5 years.
I just had some color around, that further fragmentation. And so I think, again, if the consumers of liquidity, they have different requirements. And so, as Aurora alluded to, selling 2 Bitcoin versus selling 1,000 Bitcoin is a vastly different thing. And so similar to what you see in TradFi and equities, if you have an alpha in this size, you would turn around and hit a bank algo and they would work out of that, or you'd ask a bank for a two-way as opposed to sweeping order books. And so I think the build for OTC, and certainly as a prime broker to sit in the middle of that, will allow counterparties to interact with, frankly, more liquidity destinations in a more optimal way, measured by best execution as requirements come around it.
Gotcha. Aurora, do you have anything to add?
Yeah, no, look, I think competition is key, and I think I think this environment, I think, will flush out, the bad. You can never fully flush out one, but hopefully, bad actors get flushed out, or certainly don't have the credibility to have the longevity. And so I think, particularly on the DeFi side, I think there's still a lot of barriers to entry for a lot of traditional funds to have access to this space. And I think it's still, until there's some sort of KYC potentially solved in DeFi, it will be quite difficult for regulated funds to participate.
Gotcha. And then question from John Tornator. I'm going to rephrase it a little bit, but would love to hear from the three of you on your general thoughts on regulation, and particularly today's election day. Where do we see regulation headed, and how will that affect the broader market, particularly within crypto?
So I think regulation, we all probably think is a good thing. It's going to provide the certainty that this industry needs, and for institutions, again, to adopt it and ultimately better, protect the retail consumers in the space. I think the key is that the regulators properly engage the industry players to make sure they understand, the blockchain, various trading strategies, and the nuance, of digital and how that trades. But ultimately, there will be different regulations around the world in different places, and I can assure you, at my firm at Hidden Road, we will be positioning ourselves accordingly, and I suggest that the industry does that as well.
Yeah.
I suspect too I suspect with the framework from the US, once it gets fully defined, I suspect there'll be some sort of passporting or equivalence in other major jurisdictions.
Yeah, I've been dealing with this issue for 20 years, right? Whether it's crypto started out basically leveraging money transfer regulation because it was the closest thing they could figure out with stored value via FinCEN, which then percolated down to the States, and now it's moved over into the institutional side. And The issue is not, do we need more regulation? The issue is, do we have proper adherence to existing regulation? We're overseen at Abra by 70 plus regulators, at least, probably more. And obviously the high touch nature of some is different than others, but the rules are the rules. And so, I think maybe in the issue of US based securities law, there's some gaps that we would like to see addressed. I'd like to see the SEC finally implement the Dodd-Frank mandated swap execution facility regulations that we've been waiting for over 10 years. But by and large, the rules are the rules, and people know what to do. The question is, are you doing it? If you're basically custodying funds as an exchange, you're required to have 100% reserves. So you shouldn't have a liquidity crisis. That should not be possible. Full stop. No bullshit. I mean, I don't want to hear. There's no excuse. There's really nothing to say. So if you have a liquidity crisis and you're an exchange, by definition, there's some rules you're not following, right? So we don't need more adherence to them. We need more adherence to what's already there. We don't need people to basically create more that other people aren't going to adhere to anyway, right? So that's the issue in my humble opinion.
Gotcha, Mike. It looks like you had something to add there.
I agree. I don't want to comment too much on the recent day's events, but I agree with Bill. Makes sense.
Gotcha. We probably have time for one last one. Let's see. Is Wintermute servicing smaller token projects or sticking mainly to the larger, more prominent projects?
It's a great question. We cover a range of projects. It depends on the team. If we provide sort of market making services for the token issuers, we look at the team, the investors behind them, and where we see if there's longer term interests aligned and we believe in the project, then we would support them.
Gotcha. Okay. Well, I'd like to thank our guests for joining us today, and it's been a crazy couple weeks in crypto. And as a reminder to everyone, we've been recording this session, and it'll be up on the Block's YouTube page as well. Thank you to our guests, and hope everyone has a good day.
Thanks very much, Greg. Take care. Bye-bye.
Deal.
Bye.